Hi, I'm JD Davids with the Fronis Group, and today we're going to talk with Jeremy Glaser, the leader of the venture capital practice for Mintz Levin. Jeremy, welcome today, and glad to have the opportunity to sit down and talk with you about venture capital, how to raise money, how to get startup investors, and some of the things that you've seen over the course of your career in working with startup companies.
Thanks, JD. It's really nice to be here. Thanks for inviting me.
Absolutely. So let's start off with your background. Tell us a little bit about, I know based on our past working together, that you're not a typical lawyer. Tell us a little bit about your background.
Well, sure, JD. So I went to college at Duke University where I was an economics major, so I was always really interested in business. Went to Harvard Law School after that, where I focused on a lot of business law and securities and venture capital and technology. And I was always really intrigued by entrepreneurs in particular. Just loved their creativity and always wanted to be part of the entrepreneurial spirit of building something, building a company, building value. And in fact, when I was in law school, I started a little business. Back in the early days of computers, I was with an Apple IIe and a daisy wheel printer, and exactly.
Long time ago.
A long time ago, and 5¼ inch floppies. Nobody knows what those are anymore. There were no hard drives.
Right.
And I built a business. Serving a bunch of different law schools all around the Boston area. And then when I graduated, I sold it.
Nice.
Came to California because, again, was always focused on working with mostly technology companies, biomedical, medical device, computer software. Obviously, California, the hotbed of those types of companies and entrepreneurialism.
Sure, absolutely. And then you haven't always, you've been a lawyer for 30 years, but you also were part of the management team of a startup company here, right?
Yes, once you get the entrepreneurial bug, it really sticks with you.
Yeah.
So I practiced for basically 15 years before I got caught up in the excitement of the .com era.
Right.
I had a really exciting client who was just a very unique space, very early on as a B2B exchange.
Yep.
One of the most exciting businesses that was really very transformational for the healthcare industry, and we raised a lot of money. We raised over $100 million from top VCs, Kleiner, Sequoia, Oak, Meritech, and in fact we went through an IPO process. Unfortunately, did not get out before the .com era ended.
Sure.
And we ended up selling the business ultimately, and then I came back to the practice of law.
Sure.
And I'm glad you mentioned that, JD, because I've always really felt that experience of working for 15 years as an attorney, both as an associate and as a partner, and then getting inside a company and really experiencing that growth and just the energy of what it's like to be in a startup company really dramatically changed the way I practice law and the way I interact with my clients.
I completely agree. I mean, if you've been in the trenches as a member of the management team and you raised $100 million from Kleiner Perkins, Oak, Sequoia, and who was the other one?
Meritech, which was the later stage fund for Oak.
I mean, that's fantastic experience, and I'm sure that lends itself well to you helping your clients in figuring out how not only to do the legal side of it, but also how do you manage board meetings after you raise the money?
Absolutely, JD. So I love to spend time with my clients at really helping them think about their business and what does that mean, how to position it. So when you're going to go out to raise money, what should an executive summary look like? And I've been fortunate to work with literally hundreds of companies in drafting executive summaries and PowerPoint presentations. Again, both for my own company back with the venture-backed company I was with, but also with a lot of clients.
Sure.
And I really think it's not just being a lawyer and just doing the legal work. It's also really helping the client make sure that they're best positioned to succeed, which can be financing, which could be getting potential customers, helping clients get the right employees. I've established a vast network of relationships that I can refer people to find the right people to fill the right gaps.
Sure.
And I'm proud to say a lot of my clients, in fact, even have me interview people before they hire them to get my sense of whether the person's a good fit, technically and culturally.
Nice, nice. So you mentioned the executive summary. Let's talk a little bit. You from like many investors and lawyers, you probably see hundreds of them. What do you see as some of the most common mistakes that entrepreneurs make in their executive summary?
Sure. So, I mean, look, when you're an entrepreneur, you fall in love with your solution, right? You think that you've seen a problem, you've designed something to solve that problem, that's very exciting. And look, that's wonderful, and that is clearly why you're going to create something of value. You found a need, you're filling that need with some new technology that's going to solve that. Unfortunately, what happens is the entrepreneurs are so focused on that issue and the technology that I see executive summaries that only address that.
Right.
And that's only part of the equation of what it takes to get an investor.
Right.
Investors are looking for more than just a technology that solves a problem. Yes, that's a requirement, but you also need to have a management team that has experience and preferably even has some prior successes, and preferably in a similar or related space. And you need to also be able to explain how are you going to make money.
Right.
And that's probably the one thing I see most often that surprises me when I get executive summaries, how often entrepreneurs fail to discuss what's my revenue model, how am I going to charge for this, and how am I going to make money.
Right.
I always like to tell entrepreneurs that you need to put yourself in the shoes of the investor.
Right.
Why is the investor investing in your business? Sure, there's some investors who just love technology. There's some investors who want to change the world, right? That's the term we always use. But the reality is investors are in the business of making money. If you don't show them how you can make revenue and build a business that has value down the road, you haven't showed them how they're going to make money, and they're not going to invest.
Absolutely. Well, and I see that a lot on Shark Tank as well. Kevin O'Leary, Mr. Wonderful, oftentimes entrepreneurs will get in front of him, they'll talk about the product, and then he drills right in. How much does it cost you to manufacture? What's the retail price going to be? And how are you going to distribute the product? And the entrepreneur sometimes knows those answers, and sometimes they're kind of knocked back on their heels.
Yes.
Let's talk a little about the executive summary. More specifically, what is the thing that sets apart the ones that actually get a meeting from the ones that don't? In fact, talk a little bit about the statistics of how many executive summaries are in the pile, and how do you make sure that you get in the yes pile and get a meeting as opposed to the no pile?
It's a great question, JD. So I always explain to my entrepreneurial clients the following. I say, how do you know what business somebody's in? And the answer is, you look and see what they do every day. If you look at what they're doing every day, that's pretty much the business they're in, right? So what do I do every day, right? I advise companies on financing, I advise companies on M&A, I form companies, right? So I'm in the business of being a lawyer to entrepreneurial companies.
Right.
So then go look and see, what does a venture capitalist do every day? And people wrongly say, oh, they invest in businesses. No, that's actually not what they do every day. The typical partner at a venture fund might invest in 2-3 companies in the course of a year. Would be a lot for a venture partner.
Sure.
So what are they doing every single day? They're reviewing business plans and saying no. They're in the business of saying no to potential investments. So the key with your executive summary is to figure out what are the things that make venture capitalists say no, and make sure that your executive summary doesn't have those in there.
Right.
That gets you out of the no pile and into the yes pile.
Right.
I think, I always start from the perspective that you need to put yourself in the shoes of the investor.
Right.
And that investor is being inundated with sometimes hundreds of business plans, executive summaries in the course of a day or a week or a month. And so they just want to get through them. And so you need to be able to get their attention quickly without them having to read a lot of detail. Because again, the purpose of that executive summary, as we've talked about so many times, JD, and working with clients together, it's not to get the investor to invest. You don't have to tell the whole story. I've been doing this for 30 years. I can tell you, I've never seen an investor, well, one exception. I've never seen an investor, with that one exception, invest based on an executive summary. There's always going to be more. So the purpose of the executive summary is to get them to pick up the phone and call you and set up a meeting, or to respond to your email and say, hey, I'd like to meet with you and have a meeting. That's all it is.
And you and I have talked about this a number of times, and gosh, I think we've been working together 15 or 20 years, and I can remember one particular client where we were all very clear on the management team. The goal of the executive summary is to get a meeting. And then we would practice our pitch and go in, what's the goal of the first meeting? To get a second meeting.
Exactly. Always a great perspective.
Yeah, and we always realized that, the idea is not to pitch them on the whole thing and give them all the information, because then you're going to do 80% of the talking, which is not really good, because you really want to build a relationship with that investor so that they can, if you give them all the information, then they don't have any questions to ask. And then it's not a dialogue, it's a monologue. And so I think the key with the executive summary is to give them just enough information so that at the end they ask you for more information.
I agree. And maybe just to dive in a little bit on that, and I've actually written some articles about this, I really do think it's pretty simple, right? There's a pretty simple formula for an entrepreneur who's going to do an executive summary. You got to tell them what are you doing?
Yep.
One sentence, what are we doing?
Yeah.
Okay. Second sentence, why does it matter? Meaning, what's the problem and how much money are you going to make off of it?
Right.
And then the third thing is, and why are you the guy that's going to pull it off?
Exactly.
Right? If you tell a VC those three things and they quickly see that, and I tell every entrepreneur, the first paragraph needs to answer all three of those questions. I need to read that and go, oh, okay, I see the product. Oh, I see it's a really big market and I see how you're going to make money in it. Oh, and I see this is a management team that can implement. I'm done.
Right.
I'm going to have a meeting.
Exactly. So let's talk about some of the gotchas, because in previous conversations, I think we decided that sometimes one of the most common reasons that an investor will put your executive summary in the no pile is because you don't have a team with a track record. Does having people on your advisory board make a difference in that realm?
So I'm a big fan of advisory boards because they can provide a lot of value to an entrepreneur, especially because a lot of entrepreneurs are first-time entrepreneurs. They don't have experience in building a product or selling the product or manufacturing or handling and managing employees. So I'm a big fan of advisory boards.
Yep.
But that said, I don't think I've ever seen a transaction, JD, where an investor invested because of who's on the advisory board.
Sure.
I don't think that really helps in that regard. It's
Sure.
not a negative,
Right.
but it's not what's going to push you into the yes pile.
Right.
So if you're a first-time entrepreneur, how do you get funded? I think realistically, what happens is you have to be able to build some credibility that your business is real.
Right.
It's really difficult for a first-time entrepreneur to get funded unless they've got a built product, a customer. I mean, the term the VCs like to use is, you got to show that the dogs are eating the dog food.
Right.
And if you don't have that, especially in the world today, and really the world as it's been since the dot-com era back in 2000, 2001,
Right.
if you don't at least have a product done and some customers and you're a first-time entrepreneur,
Yep.
I would venture to say it's going to be very difficult to raise professional venture money.
Right.
So do that first and then go out to the venture capitalists.
That makes sense. I think something that both of us have seen with entrepreneurs over the years is that they have a tendency to use the shotgun approach to fundraising, particularly for the earlier stages in looking for angel investors. What advice do you have with regard to making sure that they get the right investors in the deal, and where do they find them?
It's, again, such a great point, JD. Yeah, the shotgun approach is something that really can only hurt you. So I've learned over, again, doing this for 30 years, that there's a process that you can follow that dramatically improves your chances of getting funded. So what's that process? You need to identify a handful, call it 5 venture capital firms that either you know or your advisors know well enough that they're going to take the time to actually give you some feedback. Because here's the reality. No matter how good you are at your exec summary, no matter how good I am at reviewing it, ultimately it's the investors and what their mindset is and what they're looking for who are going to decide whether or not it's speaking to them.
Right.
And what I've seen is that time and time again, we end up pivoting, right? Changing our approach on that executive summary based on information that we get from investors.
Right.
So why would you do a shotgun approach? Why would you draft this thing out and then send it out to 100 potential investors before it's been fully baked, before you know it's actually answering the questions that they need answered,
Right.
before you know that it's really tailored to the way they're thinking in the current environment? So
Right.
you never do that. You pick up a limited number of people, you get it in their hands, you get really good feedback, you iterate, and change. And then, after maybe 5, maybe even 10, firms that have given you some feedback, then you sit down and go, okay, now we think we actually have the secret sauce.
Right.
And even then, it's a very careful process. You really need to go through, and we help companies, I know you do as well, JD, at understanding, who's a good investor, what does that mean based on experience in the space or the size of their fund or dry powder in their fund. All these things really, really matter.
Sure.
And maybe just to make one more point about why the shotgun approach really doesn't work. I don't think entrepreneurs really appreciate, going back to what we talked about before, that the VCs are in the business of saying no.
Right.
And once they've said no because they got hit with the shotgun, it's so hard to get them to pick it up again and open their minds to the possibility of investing.
Right.
So why would you ever lose that opportunity by not putting your best possible foot forward when you get that one shot at them?
Right. And that's one of the main things that I'm working with a lot of the companies that I'm coaching and mentoring right now, is helping them put together a target list of specific investors that already have got exits in the specific vertical that they're operating in. Because I think, as you and I have talked about before, particularly for early stage financing, there's only two ways you're going to get that deal done. Number one, somebody that already knows you that can write a check, or they already have industry expertise in that domain. So whether it's angel investors or venture capital firms, it's important to build a target list ahead of time.
Totally agree, and I think you've given, you've shared with entrepreneurs such an important nugget, right?
Right.
So many times entrepreneurs will show up at my office telling me that there's a lawyer who told them they're going to help them raise angel money, or there's some investment banker who's going to help them raise angel money.
Right.
And I got to tip to 30 years, I just shake my head.
Right.
Because the reality is what you just said.
Sure.
That when you look at where the angel money comes from, there's always exceptions, but the vast, vast majority of angel money comes from people who know the entrepreneur personally, or made a bunch of money in this space or a similar space, so they really understand it.
Sure.
So the reality is there an investment banker or a lawyer that can help you identify those two people?
Right.
The answer is not really. Certainly the people that know you, they know you.
Sure.
So only you can identify them, and only you can reach out to them to get them to invest.
Right.
And now the industry side, sure, a good investment banker or maybe a good lawyer can certainly help you identify people that have made money in that space, of course.
Sure.
But the reality is, I tell entrepreneurs, you know your industry better than anybody else.
Sure.
You know what the competitors were, who the companies that had good exits are. So again, at the angel stage, I think it's actually very difficult to do that with anybody's help. Now on the VC side, very different because it's a fixed universe.
Right.
We all know what people's expertise are, and just doing good research, you can determine who had exits in the space and identify the right people to go to.
So Jeremy, you've helped a lot of companies raise a lot of money. You've seen your clients be very successful. You've seen the ones that were learning opportunities, right? If you had to give entrepreneurs just one critical piece of advice, what would that be?
So JD, I always remember a speech that I heard, this is probably 20 plus years ago, from a very successful entrepreneur who built a really large software company. Right. And he stood in front of a group of literally hundreds of people here in San Diego. And at this time he was an angel investor investing in companies, and he was talking about how does he pick companies to invest in. Right. And he said, I have one diligence question that determines whether I'm going to invest in the company or not. And that question is, would the person, the founder, rather be CEO or be rich? And I remember sitting in the audience thinking about that for a second as an attorney who'd been working with companies for a number of years and seeing a lot of entrepreneurs that had built very successful companies to very successful exits, and others unfortunately who didn't. Sure. And I thought that was such an incredible nugget because it captured so many things in just that process. So if you take a step back, what does it mean if a founder, entrepreneur wants to be CEO? What it means is that he or she wants to be in control of the company. They want to be the decision maker, they want to be the person who is making all the decisions, and if that's their number one goal, they're missing out on another very important goal, and that is getting rich, building a big, valuable business. Right. And unfortunately, those two things can sometimes be in directly, competition as to whether or not you're going to be successful making a lot of money if your focus is just on being CEO and containing and keeping control. So I really do advise entrepreneurs to take a step back and take a look at yourself and ask yourself, what is my skill set? What am I good at? What am I not good at? And to really ask yourself also, why are you in this business? If you really want to change the world, if you really want to bring something to the market that's not there, and ultimately create a lot of wealth and create a lot of value, then you need to be focusing on all those things that drive you towards that. And unfortunately, you holding on to the CEO position tends to create behavior that doesn't result in that end result. So again, I thought that was just a wonderful litmus test for companies, and I use it all the time when I meet with entrepreneurs.
It makes a lot of sense because at the end of the day, if you want to take the wonderful product that you spent so much time and energy in building, if your primary goal is to get that product in front of as many customers as possible and sell, hundreds of thousands of millions of these products, you have to be willing to build a team. Yes. And in order to build that team, whether you're talking about the executive team or the board of directors, it's important to understand what you're really good at. And I think you and I have seen this a number of times, and I think they call it the smartest guy in the room syndrome, or the smartest person in the room syndrome. Talk a little bit about some examples around that.
Yeah, so as you were saying that, I can unfortunately go through a number of different clients I've worked with over the years where, the entrepreneur, and we could do psychoanalysis about why the entrepreneur was this way, but the entrepreneur really had to be the person who was right. It had to be their idea. They had to be making all the decisions. If the venture capitalists on their board were asking tough questions, rather than asking themselves, well, gee, why is that a question I should be thinking about? How's that going to help me build my business? Instead, there's a lot of defensiveness. And so I totally agree with you, JD. When I look back over my 30 years of working with a lot of entrepreneurs, and I think about the entrepreneurs that have had big exits, $50 million, $100 million exits, I'd say all the time, they were people who knew what their strengths were, knew that they had to bring people around them both on the management team and also from investors who built around their own weaknesses, all with the goal of not being the guy in charge, but building a big business that was going to make them, their executive team, their employees, and their investors hopefully fabulously wealthy.
Absolutely. I completely agree. You have to build a team. And I think it brings me back to one key example that really bore that out, and that's Mark Andreessen with Netscape. I remember it was 1995 when they went public, but just prior to that, just a couple of years prior to that, he was a student at the University of Illinois, Champaign-Urbana. He came up with the Mosaic and the WYSIWYG editor and the browser of Netscape. And instead of saying, well, I'm the smartest guy in the room because I invented the product and I want to control this whole thing, he partnered up with Jim Clark, and he allowed Jim Clark to be CEO. Mark, at that time, who is a brilliant, brilliant venture capitalist today and amazingly successful, amazingly wealthy with Andreessen Horowitz, right? Everybody knows who he is in the software world. He's one of those guys that was smart enough to know that he was, at that time, the technical guy, and that he didn't have the experience that Jim Clark had in terms of raising money, managing a board of directors, taking a company through all of the massive growth that Netscape went through, and then getting through an IPO. He probably would have buried the company, but today he has evolved, and now he finds himself to be a very successful
I think
VC.
that's such a great example, right? I mean, there you just said it. He clearly preferred to be rich than to be CEO, and look at the success he had.
And I think the beauty of that is that Jim Clark really kind of took him under his wing and showed him, wow, you're a brilliant engineer. I'm going to show you the path, kind of like a Sherpa, right? Here's how we climb Mount Everest. I've done this 100 times. I'll take you by the hand and show you how to do it.
I think that's such a great point. And and it doesn't mean that you can't be CEO. So that's an example where the founder said, I shouldn't be CEO and this person should be CEO. You can still be CEO and have the investors play the role you just talked about. So this really goes to, again, who are the right investors? So look, there's plenty of investors out there that have cash. The real investor that provides real value is the one that provides advice, who can help you avoid all the pitfalls, all the potholes that are the obvious ones that they've experienced or seen other companies experience over and over again. So if you get the right board, and this we could talk about, the right board and the role of the board and how to interact with the board. But if you get the right investors, and from that investor, the right person sitting on your board, they can help you. They can play that role and be that Sherpa and help you navigate up the mountain.
I'm glad you brought that up, because getting the right investors is something I've spent a ton of time on, and we've got this new series, the Smart Money Startup Series, where it not only explains why it's important to get smart money investors. It's not that, if you've got a mobile app company, right, and you go pitch all the angel investors in your geographic community, right, it's not that those people aren't really brilliant people and really successful, but if you've got a mobile app company and you're pitching to people that made all their money in real estate, their money is green, but it's, for lack of a better term, dumb money, right? Because they don't understand the mobile apps space. However, if you go and you identify a list of smart money investors that have been there and done that in something related to the mobile payment section, then they're going to be able to open up doors you could never open up on your own.
I totally agree. And as you talked about, they'll also be able to tell you all the places where there can be mistakes, errors, and help you avoid those things and really dramatically improve your chances of success. Again, I think about specific examples. So I can think of an example of a CEO of an internet company that had a really, really good idea. But unfortunately, because he was unwilling to give up control and was unwilling to take, the dilution, which is a term that, to be honest, drives me crazy, and we should talk about what dilution actually is.
Right.
I think there's a misunderstanding about that. But because he wasn't willing to do that, he didn't have people around him who, by the way, had come to him and offered to invest.
Right.
But he didn't have those people around him to advise him when things turned down.
Right.
After the dot-com era started to collapse, and his business shrunk dramatically because of that.
Exactly, exactly. So let's talk a little bit about getting the right people on your board of directors, particularly the investors, and talk a little bit about your experience and your advice for entrepreneurs in that realm.
Sure. So, getting the right board and then managing the board
Yeah.
is such an important role for any founder and any CEO. And it's one of these areas where I've been fortunate again to sit literally in clearly thousands of board meetings over the years, and I got to see CEOs who handle board meetings well and have attracted the right board members, and then CEOs who haven't. So let's talk about the right board members. I've had clients, unfortunately, who have filled their board with friends, with people that they know and trust, without really any regard to whether or not those people could provide substantive value to what they're trying to do in the business. It's sort of the classic yes men board, right?
Right.
I'm careful to not use the term never, but this is one where I can say never.
Yeah.
In 30 years, I have never seen a company be wildly successful with a yes man board.
Right.
It's just that you're not going to be getting the objective advice. You're not going to be getting the things we talked about, the things where your strengths are versus where your weaknesses are. You're not getting those gaps filled if you have a yes man board. So again, it goes right back to you need to be comfortable that, yeah, you might lose control if you put a board in who is independent, who has industry knowledge. But you're going to dramatically improve your chances of surviving the inevitable challenges, issues, downturns that are going to occur as you're building your business if you have people on that board who've built companies, who understand the pitfalls, who have the patience and the knowledge to wait out difficult times because they know what's on the the backside of that, the success that will come.
Yeah.
So I can't emphasize how important it is to build your board with a view towards what are the things that you need to help you be successful. If you're a great technology person, but you're not very good at marketing, sure, you need a good VP marketing and that'll help fill the gap. But put someone on your board who has a strong marketing background, who could help you understand how to be the best marketing, do the best marketing for your product. If you're really strong in finance, but you're not strong in technology, then go find that technologist who has a deep understanding of the technology and put them on your board. Board seats are I think are an undervalued asset. It's so valuable, and it frustrates me when I see entrepreneurs fill these valuable seats with an internal resource. Like, I'm sorry to say this to all CFOs out there who might be listening to this, but why would you put your own CFO on your board of directors?
Right.
You have access to that person's brain 24/7. Why are they on your board of directors? You've just wasted a board seat. And by the way, same with the lawyers. I cannot understand why a company would ask their external or internal lawyer to be on the board. You have access to that person anytime you want.
Sure.
Fill that board seat with someone who's bringing something to you that you can't get from an internal resource or a hired external resource.
That makes sense, absolutely. So let's talk a little bit about managing a board of directors after you've got the money in the deal. How does the CEO and the management team and the founders in particular, what are some of the things that you see them do well and some of the mistakes that they made in managing not just the board meeting, but their relationships and communications with the investors and the board?
So JD, working with a board is very much like a marriage, right? It's always about communication, right? Communicate, and if you think you might have over-communicated, good, over-communicate a little more.
Right.
So again, when I look back at situations where I've seen, real problems between board members and the CEO, it comes from either a complete lack of communication or communicating in an overly optimistic way. So you're communicating, but you're not really communicating the challenges, the difficulties. Usually, unfortunately, out of fear that the board members might run or they might seek to replace you because they see some challenges. And I've tried to counsel entrepreneurs over the years that that's actually not true.
Right.
When I look back again over all these companies I've worked with, and unfortunately a lot of CEOs who have been removed from their positions, they're not removed because they've been telling the board about how difficult the business is and the challenges that they have. They're removed because they're showing up at board meetings with wildly optimistic projections over and over again that they fail to meet quarter after quarter after quarter. That's when you get your head taken off.
Right. And that happens even in pitch meetings as well. I think that's a big mistake that a lot of entrepreneurs make, is they want to go in with these very wildly optimistic, sort of overpromise, undeliver, and that's the death knell that will kill you faster than anything.
That's right.
In fact, that brings up another point, is talk about transparency in managing a relationship, particularly with your lead board member. And I think one of your favorite topics is no surprises in board meetings.
No surprises in board meetings, exactly, JD. And you and I have witnessed this and talked about this. And it's again, sort of so frustrating, because you would think it would be so obvious. And yet, I know entrepreneurs are busy, and I know there's a lot going on in the company, and it's hard, right, to pick up the phone and explain to people what's going on. And you've got a board meeting coming, and you think, oh, I can update them then.
Right.
That is such a mistake.
Yeah.
I've seen so many board meetings where the CEO walks in and starts talking about whether it's hiring a new employee or option grants on the positive side,
right,
or loss of a customer, or something that's happened in the business on the negative side. And the first time the directors are hearing about this is when they were sitting there in the room. What do you think is going to happen when you hit a bunch of very intelligent, capable people with a complex problem, and you ask them to deal with it on the go in front of a bunch of other people without the ability to process it, think about it, understand it? What happens is what happens. They'll pepper you with questions. They'll sort of turn off, shut down, want to push the decision off, and it creates a really bad dynamic. So one of the first things I do when entrepreneurs take money is I meet with my CEOs, and I give them sort of a mini how to run your board meeting.
Right.
And what that means is, yes, it's running the board meeting, but it's all the work before the board meeting too. It's picking up the phone, making sure that you've talked to, if it's the lead director or if it's all the directors, it's sort of individualized based on the company, but that you've talked to them about the issues that you're going to be bringing up in the board meeting. You've already gotten their feedback, you've gotten their input. So when you walk into that boardroom, you already know what the issues are, who's in favor, who's maybe not in favor.
Right.
And you can address that situation and then push the ball along to the result you want to get. If you don't do that, you're just going to create a real negative atmosphere, and you're not going to achieve your end result. And yet, this sounds so obvious, and I tell entrepreneurs this all the time, and I can't tell you how often I see the CEO come in and drop the bombshell, good or bad, on the board, and they're totally unprepared, and it just results in a terrible board dynamic.
Yeah, absolutely. And I think we've both seen examples of that, where if the CEO is truly transparent, particularly with the lead director, about the good, the bad, and the ugly, then there's a relationship based on trust.
Yes.
But if you come in and and you say, okay, well, we just lost this customer, but we're going to probably go get him back, and as you say, that director hasn't had the opportunity to really digest that before you go into the board meeting, it makes them wonder, what else are they not telling me?
Yes, exactly. And look, it's just human nature too, right? People love their own ideas and don't usually love ideas of other people.
Right.
So why wouldn't you want to make the ideas of what you want to achieve, make those ideas the ideas of your board, and then you're going to get what you want for your company.
Exactly. That makes sense. Let's talk about a little topic that's very near and dear to a lot of entrepreneurs' hearts, and that is the one of valuation. When they're first going to market, particularly with a first-time or maybe a second-time entrepreneur, they've got a great product, they've got a great team, and they're starting to get traction with customers. Talk a little bit about some of the stories that we both have some of those stories around valuation. Talk a little bit about your experience in that realm.
Yeah. So this again goes back to what we talked about on the VCs sort of putting you in the no pile.
Yes.
So I always start the conversation about valuation with my clients by pointing out to them that the reason that a venture capitalist asks you very early on what your valuation is not because they actually care what your valuation is. That's not going to have any impact on what their decision is about, what they think the valuation is.
Yeah.
They're asking you for one reason and one reason alone. They want to know whether they should say no.
Yes.
And it's amazing to me how often entrepreneurs will still answer that question, and then they end up, the VC doesn't invest because the valuation was too high, it wasn't in line with their thinking. And again, you got to go back to venture capitalists. Every day they're being inundated with lots of opportunities. They've got to make very quick decisions about what to invest in and what not to invest in. If they hear you coming in with a valuation that they think is not market or not one that they're prepared to invest in, all you've achieved is had them say no, and you haven't gotten to that next step. So let's talk about that next step. And you and I talked about this, that yes, the goal is to get a meeting. And yes, after the meeting, the goal is to get the next meeting. But then after that next meeting, what happens is you get a term sheet. And that is fundamentally the goal of the whole process, and then getting to closing. So what happens when you get a term sheet? What happens is that the entire balance of power changes. Until you get a term sheet, the VCs are in control, right? They're the ones making the go or no-go decision. So you work to get a term sheet, and guess what happens when they issue the term sheet? They've now had multiple meetings. They never issue a term sheet without getting to the full partnership and having a conversation about your business. So they've presented their full partnership. They've gotten buy-in on the investment. Their partners are all excited about this opportunity. So guess who now has the power once the term sheet's been issued?
The entrepreneur.
The entrepreneur, exactly. So what if the venture capitalist puts a valuation in that term sheet that you think is unacceptable? Do you have to accept it?
No, of course not.
Of course not. You can say no. And as you and I have talked about too, within the limits of the law and within limits of confidentiality obligations, you can also let other investors know without identifying things that would violate your confidentiality obligations. I got a term sheet. And that changes the whole dynamic. So why would you ever put something in the way of getting you to that point? And if you talk valuation too early, you've done that. You've prevented yourself from getting to that tipping point where you can then have a lot more power in the negotiation with the investors.
That's exactly right. I can think of at least 2 clients that you and I have worked on together where we actually took your advice and it worked out really well for us. When the valuation question came up in the pitch meeting, we took your advice and we said, we're going to allow the market to determine what the valuation of this transaction is. We're more concerned about getting the right investor in the deal, and if we get the right investor, we're not going to let price become an issue in getting a deal done. And that sent a signal to those investors that we're willing to not take a bad valuation, but that we're going to be reasonable to negotiate with. Because I think I've seen that. Yeah, I think you and I've actually heard VCs whispering in the hallway at conferences before. And they said, well, oh, what did you think of such and such a company? And the other one said, wow, you know, great team, great product, but they have unrealistic expectations on valuation. That'll kill not only the deal in the meeting that you just had, but word gets around really quickly. If you have unrealistic expectations on valuation, they're immediately going to slap a label on your forehead that says problem child, no deal.
And it's also so important to really focus on where does valuation matter and why do you care? The only reason you care about valuation is because at the end of the day, when you have the exit, it's going to determine how many shares you own. Okay. So that's fine, but it's sort of simple math that I tell entrepreneurs all the time. You can own 100% of a business that's worth $10 million. Or you can own 10% of a business that's worth $1 billion. You tell me which one you'd rather own.
Smaller piece of a bigger pie.
And so getting overly focused on valuation, I think, is another symptom of I'd rather be CEO than be rich. And so I think your point is well taken. It's not that the VCs think, oh, good, we can negotiate a really low valuation and steal this company. When they hear your answer to their question, they say, these guys want to just build a really successful business, and they understand that if we build value together, they're going to make a lot of money, even if they have perhaps lower ownership of the business.
Absolutely. So Jeremy, I get a lot of young entrepreneurs and first-time entrepreneurs that come to me, and we're working through a lot of the pitch things in the executive summary. And pretty quickly they start asking me questions about convertible notes and all that kind of stuff. And then they're always asking, well, how do we pick a lawyer? And they always want to go hire the least expensive attorney that they can get. So let's talk a little bit about how you recommend entrepreneurs go about making the decision of who they should hire to do their legal work when it comes to financing their company.
Sure, JD. So it's really important, especially when you're doing financings, that you do a lot of them. And why is that? Because so much of financings is what are the current terms, what is the market, what are the angels or venture capitalists looking for, not just valuation as we talked about, but structure. You know, what should the preferred stock look like? What's the multiple that they're looking for today? Are they asking for participating preferred, or, you know, and if so, can you get a cap? And if you're not doing this on a daily basis, you're not going to have the knowledge of all the different changing terms that are crucial to being able to get a deal done.
That's a really good point, because you want to have an industry standard deal. When you go talk to angel investors or VCs, you want the expectation to be that we're going to do the same type of deal that they do every single day, so that you don't stick out as, you know, somebody that wants to do it differently.
That's right. Again, it's another reason for them to say no, right? If the structure isn't something that they're accustomed to and used to.
Right.
And also, just even if they come to you with their term sheet, if you come back to them with a lot of sort of off comments and not really understanding the way the deals are done, that could really drive them away and potentially you lose your deal.
Sure.
So I always start with the perspective that you want to make sure that the person that you're dealing with is an expert in what they're doing. And the example I give to my entrepreneurs is, if you are out jogging and you have a massive heart attack, are you going to pick up the phone and call your GP, or are you going to call your cardiologist, right?
Right.
When it really matters, when you've got something as important as the life or death of your company, raising money, growing your business, achieving your dream, why are you going to go to the GP when you have heart problems?
Right.
You want to go to the expert who's done it a bunch of times, who knows all the ins and outs and how to get it done right, and you don't want to take the risk in going to somebody who does real estate and litigation. Oh, and I dabble in corporate too.
Right.
That's a mistake. And I got to tell you, on the point about saving money, I cannot tell you how many times I've had this conversation, and unfortunately some of the folks who've made, in my opinion, the wrong decision, and they hire somebody who is a solo practitioner or at a smaller firm that doesn't do a lot of these transactions because they think they're going to get a lower price. I get phone calls afterwards telling me, Jeremy, you were right, that because they didn't understand how these transactions worked and they didn't do them all the time, we ended up with a much higher bill than they had told us it was going to be, or that it would have been if you had done it. So you don't want to focus on only billable hours, billable rates, because that certainly has some impact.
Right.
But what you want to focus on is experience, somebody who does it all the time, because they're the ones who are going to get your deal done efficiently, they're going to get it done correctly, they're going to protect you, so you get your ownership and you get to keep it. I always like to, one of my favorite things to tell entrepreneurs is, there's a lot of lawyers who can help you get the money, but there's only some who can make sure you keep it.
It's a really good point, because there are some gotchas in there in terms of clawbacks. If you do it wrong, the investors can actually demand their money back.
Right, or you end up in a situation where you've given them way too many controls or way too many rights, and you think you're going to make money on a sale, and lo and behold you don't, because it turns out that they negotiated a 5x liquidation preference and you didn't know that that wasn't market.
Right, that's a really good point. You want to have a deal that's pretty standard. And I've even seen many examples of this, particularly with people that are going to bring in an angel investor. And they're like, well, we just need a standard convertible note. And, my Uncle Bob's an attorney and he can draft it for us and everything. And I always like to describe it as, look, we never have enough money to do it right, but then you're going to have enough money to do it over again later and to unplug that. And when you're close, you've raised angel money and you try to take the cheaper way out. And like you say, you get some non-standard deal that's in there, and then you you get a term sheet from a real sophisticated VC, and you show them the convertible note that you did with Uncle Bob the lawyer that did it for a little bit of money, and they're going to be like, okay, well, wait a minute, that yet again.
Sometimes they walk. You give them a reason to say no,
exactly.
or the end because they don't want to restructure the deal and have upset individual investors in the deal.
Right.
Yeah, you can really hurt your ability to raise money.
Yeah.
And I think you raise a really important point too. It's the complexity of doing these transactions is much more than I think people understand, and it's changing constantly.
Yep.
So literally 5, 6, 7 years ago, typically a typical angel deal was a convertible note deal. You had some sort of a discount on conversion, and that was about it. Things have become much more sophisticated than that now.
Right.
The angel investors have gotten more sophisticated. They have a much better understanding of the economics of their deals.
Yep.
And so even a convertible note is not simple anymore.
Right.
You have to deal with things like valuation caps. You have to deal with what types of securities are being issued when you have a valuation cap. Are you getting more preferred? Are you getting common? And very often what's happening now is the angels are not even willing to do a convertible note. They want to do preferred stock financing. And then you have to be sophisticated enough to understand, how do you do a preferred stock financing that is enough for the angels to feel comfortable that they've set their valuation and they have some protections, but is not documenting a full-on preferred stock financing like it's done with the venture capitalists.
Yep.
Because if you're only raising $1 million, you darn better not be spending $30,000 to $50,000 documenting that deal.
Exactly.
So you need to have somebody who can guide you through what matters, what are they going to have, and not only on your side, but on their side, to talk to the investor about, you don't really need these protections at this stage, and here's why, and don't you want to make sure that your money that you're investing in the company stays at the company and isn't going out to 2 sets of lawyers to document lots of things that are just not going to be relevant in a $1 million deal.
Right.
And then you factor in, there's been so many recent changes in SEC law that you need to make sure that you have a lawyer who can work with you on all the different options. So sure, there's convertible notes, and sure you can do preferred stock financings, and those are very traditional, what we call private placements, usually to very high net worth accredited investors. But there's all kinds of new ways now to raise money. So for example, everybody's been talking about crowdfunding, and just recently the crowdfunding rules have appeared. Now look, I think the rules are complicated, and I'm not sure that a lot of entrepreneurs who are building tech companies ultimately to get venture financed are going to use crowdfunding. But for some businesses, crowdfunding might be a perfectly appropriate way for them to raise that first $500,000 or $1 million.
Sure.
But if they don't do it the right way, if they don't have somebody who knows the rules, and if they don't have somebody who also understands the impact that how you raise that money in that crowdfunding can impact your ability to raise that next round, whether it's with more sophisticated angels or with venture capitalists, you can really hurt yourself.
Absolutely. Well, it still seems like a majority of the really sophisticated deals are still using the standard old-fashioned Reg D filings. Talk a little bit about, there are, the crowdfunding that you can, if you're going to accredited investors, you can have an open solicitation. I think we're starting to see more of those. And then you've got the non-accredited investors, which I think we have to be very careful about, because that could cause a lot of problems in the long term when you try to go get sophisticated financing and they see a cap table that's got 75 or 80 investors that each put in
$1,000 each.
Yeah, right, exactly. That's
a problem.
Well, because venture investors are going to look at that and say that's a minority shareholder lawsuit waiting to happen.
You're totally right. So you're totally right, JD. Even with the advent of what we call the sort of accredited investor general solicitation offering that's been available now for over 2 years, the vast majority of private financings are still done the old-fashioned way. They're done without a general solicitation. They're done based on private communications, emails, introductions, and that's how the companies get funded. And there's reasons for that, and we could get into it. It's pretty, I don't want to complicate it in a conversation like this, but I'll just say that there are some requirements if you're going to do a general solicitation Reg D offering to accredited investors, which is all that's permissible now, that make those transactions more complicated, harder to get done. You have to get some very specific information from investors that some investors don't want to share. So a lot of companies have elected not to go down that road. And now with the advent, as you pointed out, of crowdfunding to non-accredited investors, which the regulations have finally been approved by the SEC, but they're not yet effective, so you still can't do it. But those regulations also have a lot of things you have to do, steps you got to go through to make sure you're complying with the law.
Yep.
And as you pointed out, reaching out to non-accredited investors with very small investments can have a real potentially negative impact on your ability to fund the business later.
Right.
So for all those reasons, I think we still continue to see the vast majority of financings being done as traditional private placements.
Right. And I think it also speaks to when you're selecting the attorney, you're also selecting a member, an important member of the team that you surround yourself with. And I know that a lot of sophisticated investors will look at the decisions that the CEO and the founders have made in terms of who they selected. And if you go get, an attorney with a shingle out there, there's going to be, well, okay, that's a question mark, right? But if you got a firm like Mintz Levin who's done a lot of these deals over the years, you can sort of check the box to say, okay, they've made really good decisions. And you're going to get good advice, because I had a client recently that came to me and said, wow, we did a crowdfunding, not for equity, but for pre-purchase of our product. And they sold 350 units. And it was, I don't know, maybe it was a few $100,000, roughly the dollar amount. And they came to me and they said, this is really exciting. We got orders for 350 products and we got a few $100,000. And I said, that's terrific. What do you need me for? And they said, well, we got to go raise $2 million in order to do the tooling in order to manufacture the product. And I was like, oh my gosh. So you really have to surround yourself with people that will be able to foresee the potential problems that you can find. Now,
agree.
Let me ask you a question, because a lot of entrepreneurs come to me and they're like, okay, well, yeah, this sounds pretty complicated, accredited investor versus non-accredited, and, do I have to get proof that they really are accredited, and they fill out a questionnaire and all this? If entrepreneurs just want to have a conversation with you on the phone and just ask some questions,
Sure.
Is that something that you do, or, do they have to spend a bunch of money just to get a meeting and meet you?
So of course not. I mean, look, when you work with early stage companies,
Yep.
we all realize that these companies are, light on cash,
Yep.
and we're looking really to the future.
Right.
So we at Mintz Levin, because we love to work with entrepreneurs, and we've worked with so many, companies that have gone through the venture process and gone on to be very successful companies.
Yep.
Companies like AOL, companies like Biogen, IDIC, that we understand that the end game is for you to succeed, and then we're going to succeed along with you.
Right.
So we absolutely have all kinds of programs and packages to work with entrepreneurs to protect their dollars early on, structurally. So we certainly have alternative fee arrangements. We have fixed fee arrangements for some types of projects.
Yep.
But I always come back to that the most important way for you to really protect your dollars, not to sound like a broken record, is you got to work with the people who've done this a bunch of times.
Yep.
Because that's where the money savings really come from. We've done so many financings. I personally have done so many financings. I know where the issues are. I know how to get the documents done quickly. I know how to get through the negotiations in an efficient way.
Yep.
I know not to raise issues that are going to create unnecessary changes or issues from the investors. I know how to protect the investor in the most efficient way possible. And that's what's going to really result in you keeping more dollars for the business, which I always like to remind my entrepreneurs, that's my goal too. I want the most money to be available for your business
Yep.
in those early years, because that's what's going to build a great big company.
Yes.
And then I always joke with them, don't worry, I'll get you later on the M&A or the IPO exit.
Right, yeah. And I think a lot of people really don't understand that you really don't make a lot of money on early stage companies. You're making bets alongside of them that your hope is that they will go public, or they will be acquired by another business. And all along the way, as they raise more money and grow their business, you're going to grow along with them. So it is more of a partnership. And you and I, of course, have worked together in that way for 15 or 20 years on a number of different companies. I think the one thing that would really help entrepreneurs understand that is that whenever you decide to bring people on your team, whether it's outside lawyers, your advisory board, hiring a member of your management team, you want to surround yourself with people that have been there and done that.
Yes.
Because you and I both know that over 80% of startups end up failing. And the way to increase your odds of being in the 20% or even smaller category of people that are successful is get people around you. Surround yourself with people that have been there and done that, so they can help you avoid the mistakes.
Avoid the mistakes that are common, that everybody's going to make, and that you're going to make. Because you're going to make enough mistakes that are new.
Right.
Why make the mistakes that are easily avoided and that everybody knows are there?
Exactly. And I think that speaks really well to the idea of, if you want to go get the top tier venture capitalists in your deal, do everything you can to avoid the rookie mistakes along the way.
Absolutely.
And if you want to avoid rookie mistakes, hang out with the people that have been batting in the big leagues for a long time.
Agreed.
Be willing to ask them for advice. I think that's the other thing that a lot of people don't realize, is that if you ask the right people for advice that have been there and done that, they actually want to help.
Absolutely. So, I always tell everybody, if you want to go grab lunch and just pick my brain about how to fund a company, what the market's like, what are terms, I'm always happy to meet with anybody for a lunch. First of all, I love work, as I talked about earlier, I love working with entrepreneurs, right?
Yep.
I do this because it's a passion.
Yep.
I just am so just in love with the idea of people with a new idea and wanting to create something of value. So I want to be part of it. I want to be helpful to them.
Yeah.
So sure, it's my business,
Yeah.
but it's also my passion. So I absolutely make myself available to share what I can, knowing that I still have to make a living and ultimately get paid for some work, but there's a lot of stuff that I can do that is not something I charge people for.
Well, I think that's why you've been my go-to attorney for so many years, because not only are you just passionate about it, you've been an entrepreneur when you were in law school at Harvard and you sold that business successfully, and you were part of a management team that raised over $100 million from Kleiner, Oak, and Sequoia.
Yes.
I mean, that sets you apart from, I think, a lot of lawyers. And the fact that you're willing to make yourself available to entrepreneurs to get advice without having the meter being running, I think is really a wonderful thing. So if entrepreneurs want to get in touch with you, what's the best way for them to do that?
Sure. So obviously you could always email me. My email is jglaser@mintz.com. I also am very active on Twitter, so I urge everybody to follow me on Twitter. I tend to put up a lot of really relevant information about venture capital financing, around terms, both things that I've written, but also things that I come across that I think are of interest to entrepreneurs. So you can follow me at SDVC Lawyer, so it stands for at San Diego Venture Capital Lawyer.
Right.
I'm also on LinkedIn, and we're always happy to connect to anybody on LinkedIn. So you can find me there, obviously, under my name, Jeremy Glaser. Yeah. And of course, you can always go to the Mintz Levin website, www.mintz.com, and there you'll see the firm, you can see my background and my biography, and you can communicate directly to us through the website as well.
Excellent. That's great. Well, I really appreciate you taking the time to visit with us this afternoon, and I know that you and I are going to continue the conversation in a number of different ways. I know you've published a lot of great articles on LinkedIn and posted them on Twitter, and I know that you and I are going to continue the conversation about smart money startups, where you and I working together are going to try to continue to give free advice to startup companies to make sure that they position themselves in a way that they're going to be in the top tier of the companies that are successful, and stay out of the 80% bucket of companies that end up running out of cash and unfortunately have to shut down.
I agree. Thank you, JD.
Awesome. Thanks for your time, Jeremy.
My pleasure.
All right.